Hello, today, in less than 5 minutes, K&G International Advisors will inform you about the international financial markets. This week's report is titled, The Enduring Paradox of Gold, Why a Useless Asset Remains Indispensable. Gold occupies a peculiar position in modern portfolio construction, simultaneously dismissed as an unproductive relic and coveted as an essential hedge against uncertainty. Warren Buffett has famously derided the metal for its lack of utility, observing that it generates no cash flow, pays no dividends, and contributes nothing to economic output. Yet despite this compelling arithmetic, gold has commanded human fascination for millennia and continues to attract capital from sophisticated investors and ordinary savers worldwide. This enduring appeal reveals something profound about gold's true utility. In a world of monetary experimentation and geopolitical instability, the absence of counterparty risk represents a feature rather than a deficiency. Gold's practical use lies not in what it produces, but in what it preserves. The ancient appeal that defies modern logic. Gold's monetary history stretches back over 5,000 years, predating written language and organized financial markets. Ancient Lydians minted the first gold coins around 600 BC because gold possessed characteristics that other commodities could not replicate: scarcity, durability, divisibility, and universal recognition. What's remarkable is how little this calculus has changed despite technological advancement. Gold remains scarce, with global production growing at roughly 1.5% annually while money supply growth routinely exceeds this by multiples. It remains indestructible, with virtually all gold ever mined still in existence. It remains universally liquid, tradable everywhere without need for language, legal systems, or technological infrastructure. These properties explain why central banks continue to accumulate gold reserves at the fastest pace in decades. The safe haven reality. Gold's designation as a safe haven asset reveals a more nuanced reality than simple correlation statistics suggest. Gold performs its protective function most reliably during periods of currency debasement, geopolitical upheaval, and systemic financial stress. The 1970s stagflation saw gold appreciate from $35 to over $800 per ounce as inflation ravaged purchasing power. The 2008 financial crisis triggered a sustained rally as central banks deployed unprecedented monetary stimulus. More recently, gold reached new all-time highs as government debt ballooned and geopolitical tensions intensified. The pattern reveals gold's essential character. It serves as insurance against monetary and political disorder rather than against generic market volatility. When corrections stem from fears about currency stability, sovereign debt sustainability, or geopolitical conflict, gold tends to fulfill its protective mandate. Buffett's critique and the productivity fallacy. Warren Buffett's critique deserves serious engagement. His argument is economically sound. Productive assets like businesses and farmland generate cash flows that compound over time, while gold sits inert. A dollar invested in the S&P 500 in 1980 would have grown to approximately $75 by 2024, while the same dollar in gold would have reached perhaps $45. Yet this comparison commits a category error. Gold isn't meant to maximize returns but to minimize certain risks. The relevant comparison isn't gold versus equities over a 40-year period of relative monetary stability, but rather gold's performance during periods when portfolio protection proves most valuable. During the 2008 financial crisis, while the S&P 500 declined over 50%, gold appreciated. During the 1970s stagflation, while stocks delivered essentially flat returns, gold multiplied 20-fold. The practical utility Buffett dismisses manifests precisely when his preferred productive assets face existential challenges. When currencies collapse, gold preserves purchasing power. When governments default, gold maintains value. This isn't theoretical abstraction but practical reality demonstrated throughout modern history. Gold as portfolio de-risking. The case for gold rests not on maximizing returns but on modifying portfolio risk in ways traditional diversification cannot replicate. A conventional stock-bond portfolio provides diversification within paper assets, all sharing exposure to monetary policy and financial system stability. Gold introduces an asset with fundamentally different return drivers, benefiting from conditions that threaten traditional portfolios. Gold provides liquidity during crises when other markets seize up. It requires no counterparty to fulfill obligations. It faces no bankruptcy risk, no refinancing risk, no regulatory risk. These characteristics become invaluable during tail events when diversification fails and correlations surge. Gold's appeal across millennia stems from a utility that transcends Buffett's productivity framework. It offers something increasingly rare, an asset with no counterparty risk, no political risk, and no existential dependence on complex financial systems. The question for investors isn't whether gold produces cash flows, but whether their portfolios adequately account for scenarios where paper assets and institutional promises prove insufficient.